Welcome, everyone. Ready to dive into some serious investing wisdom?
You bet.
Today, we're cracking open Common Stocks and Uncommon Profits. It's a classic written by Philip Fisher.
A book that's had a huge impact. Even Warren Buffett says it shaped his investing style.
Oh, absolutely. This book was first published back in 1958.
And it's still considered a must-read.
Think about it. That's before Silicon Valley, before personal computers, before so much of what shapes the market today.
But the principles inside, they're timeless. Really, they are.
Exactly. So what we're going to do today is we're going to unearth those golden nuggets, the kind that can help us spot companies with serious long-term growth potential. Sound good?
Sounds like a plan.
All right, so right off the bat, Fisher wasn't interested in get-rich-quick schemes or trying to time the market perfectly.
No, his approach is all about understanding the businesses.
Yeah.
Identifying those with staying power, those with lasting competitive advantages, and then holding on to them. Holding on to them for the long haul.
Yeah. That's that buy and hold strategy we hear so much about. But wasn't this book written during, this huge bull market after World War II?
It was.
You'd think everyone would be chasing those short-term profits back then.
You would, but Fisher, he saw through the hype. He understood that real wealth, it's built by owning pieces of great businesses for years, not days or weeks.
Makes sense.
Not by trying to outsmart the market every single day.
Yeah. One of the most famous parts of this book is Fisher's 15-point checklist.
Yeah, for analyzing companies.
Right. We probably don't have time to go through every single one.
Probably not.
But there are a few that really stood out to me, like his emphasis on management.
Oh, absolutely.
It's not just about looking at their track record, but it's about assessing their determination to innovate, to keep pushing forward.
Yeah, he really dives into the importance of a management team that's hungry to improve, even when things are already going well.
So give us an example. What kind of company did he use to illustrate this?
Well, he talks about Motorola back in the 50s. They were already a leader in car radios.
Right.
But they didn't just sit back and relax. They poured resources into research and development, constantly trying to push the boundaries of what was possible with electronics.
So they weren't content with just being good.
Not at all.
Yeah.
And you know what? That drive, that relentless drive, led them to dominate new markets, televisions, and then, of course, mobile phones.
It's fascinating to see how those early decisions, that commitment to innovation, really paid off in the long run.
It did.
So it's not enough for a company to be good today. They need that internal push to be great tomorrow.
You got it.
Now, you know what really captured my imagination in this book? It's this unusual research method Fisher calls
the Scuttlebutt Method.
Scuttlebutt Method, yeah. It's like having your own secret intelligence network, almost.
It is. It's pretty cool. Fisher believed that you could get an edge, a real information edge, by talking directly to the people who know the company best.
Okay, so who are we talking about?
Employees, customers, even competitors.
Competitors, really.
Sometimes. He said you could pick up things you wouldn't find in any financial report. Just imagine you're thinking about investing in a company, right? And you just happen to chat with some of their employees at an industry event. Maybe you get a sense of the morale there.
Oh, I see.
Hear whispers about a new product launch.
Interesting.
Or even challenges they're facing. It's insight you wouldn't get just from reading press releases.
Sounds brilliant in theory, but also super time-consuming.
Oh, it definitely can be, and Fisher knew that.
You can't do that for every single stock.
Exactly. Remember, his philosophy is about focus. You're not trying to analyze every company out there. You're searching for the exceptional ones. The Scuttlebutt Method, it's about that extra level of insight once you've got a company on your radar.
Makes sense. So it's quality over quantity when it comes to research, just like it's quality over quantity when choosing the companies themselves.
I like how you put that.
Okay, let's talk timing then. This is something that I think keeps a lot of investors up at night.
Keeps me up at night.
When is the right moment to buy a stock? Fisher actually has some advice that goes against what a lot of people think. He says you shouldn't wait for the absolute lowest price.
He does. He talks about a stock's real price versus its market price.
Yeah.
Sometimes a company might be temporarily undervalued.
Yeah.
It could be a market panic or some industry-specific scare, things outside the company's control.
Right, right.
But if you've done your research and you believe in the company's potential,
yeah.
Fisher's argument is that it's better to buy at a reasonable price rather than risk missing out entirely because you're waiting for that perfect dip.
It's like waiting for a sale on a winter coat that you know you'll need.
That's a good one.
You might be tempted to hold out for the absolute lowest price, but then you risk freezing because you missed the sale altogether.
Exactly.
Yeah.
And Fisher saw this happen again and again. Investors who were too focused on getting the perfect price, they often missed out on the biggest gains.
Makes you think.
It does.
So it's this balance, right? Patience, but also decisiveness. You wait for a good opportunity, but you don't let fear paralyze you.
Well said.
Now, this brings up another key part of Fisher's philosophy, and that's emotional discipline.
Uh-huh.
The market can feel like a roller coaster, and it's so easy to get caught up in the fear and the greed.
So easy.
So how does Fisher help us stay grounded when things start to get turbulent?
He emphasizes the importance of keeping your head when the market dips.
Hmm?
Remember, historically speaking, even after the big crashes, fundamentally strong companies, they tend to recover.
They come back.
They do, and they reach new highs.
Mm-hmm.
Think about the dot-com bubble bursting in the early 2000s. A lot of people panicked, sold everything at a loss, but the ones who held on to their shares in those strong companies like Amazon, eBay,
Right.
they eventually saw incredible returns, even though those stocks initially took a big hit.
That's a powerful reminder to trust the research you've done and to stay the course even when it feels like the market is falling apart around you. I bet some of our listeners are thinking, though, this all sounds great, but what if I'm just naturally more risk-averse? Is Fisher's approach still right for me?
That's a great question, and Fisher, he gets it.
Mm-hmm.
Not everyone has the same risk tolerance.
Right.
If you're particularly wary of volatility, he suggests maybe focusing on more mature companies.
Okay, so companies that are, already well-established.
Yeah, maybe not the explosive growth potential of a younger, newer company, but more stable, more predictable. They often pay consistent dividends, too.
Which can provide a nice, steady stream of income.
Exactly, so there's a trade-off. Slower growth, maybe, but less risk and, more peace of mind.
I can see the appeal in that.
Absolutely.
But even with these more mature companies, Fisher still says to look for signs of innovation, right?
He does. It's not enough to just be big and stable. You want a company that's big, stable, and still adapting to the changing world. Are they investing in research and development? Expanding into new markets? Are they constantly improving their products and services?
It's about making sure they're not just coasting, right? They need to be actively evolving.
Exactly. That drive to adapt is essential for any company's long-term success, no matter how big or how old they are.
Before we wrap up this part of our deep dive,
Okay.
there's one more Fisherism I want to get into.
I'm all ears.
He had some strong opinions on dividends.
As he did.
And I think this is something a lot of investors struggle with. Are high dividends always a good thing?
It's a great question, and this might surprise you, but Fisher wasn't always a big fan of high dividends.
Really?
He argued that sometimes companies that reinvest their profits for future growth, they can actually deliver higher returns in the long run compared to companies that are paying out those big dividends.
So instead of taking the cash now, you might actually be better off letting the company use it to grow.
And potentially increasing the value of your shares even more down the line.
I see. So it's about thinking long-term, as always.
Always.
Of course, there's a caveat here. Dividends can definitely be a valuable part of a balanced investment strategy, especially for investors who are looking for income.
That's right. If you're relying on those dividend payments for living expenses or to supplement your retirement income, it absolutely makes sense to look for companies with a good track record of paying them out consistently.
So as with most things in investing, it's a balancing act.
It is.
But it's so helpful to understand Fisher's perspective on how reinvesting those profits can lead to those uncommon profits that he's famous for.
Absolutely.
It all comes back to that long-term vision, doesn't it?
It does. It always comes back to that.
Are you after a quick payout?
Yeah.
Or are you betting on a company's ability to compound its value over time?
That's the question Fisher wants us to ask.
Well, we've covered a lot of ground here. We've talked about long-term thinking, the power of that Scuttlebutt method, and how to stay emotionally grounded even when the market feels like it's going haywire.
It can feel like that sometimes.
It can, but before we move on to the next part of our deep dive, I have a question that might be on a lot of people's minds.
Okay, with that.
Fisher wrote this book decades ago in a very different world.
That's true.
Do these ideas really hold up in today's, fast-paced, digitally driven landscape?
That is a fantastic question, and it's something I think about a lot. The world has changed dramatically since 1958. I mean, the internet, globalization, the speed of technological advancements, it's incredible.
It is.
But here's what's fascinating. While the specific companies and industries that Fisher wrote about might not be as relevant today, the underlying principles, they are remarkably timeless. His emphasis on understanding a company's competitive advantage, the quality of its management, its potential for long-term growth, these are still the cornerstones of good investing.
So even though the world has changed, the fundamentals of what makes a business successful, those haven't really changed all that much.
You get it.
It's reassuring in a way, isn't it?
It is.
Think about his focus on innovation. In Fisher's time, that might have meant investing in companies developing new manufacturing techniques.
Or new consumer products.
Right.
Today, it might mean investing in companies at the forefront of artificial intelligence, or biotechnology, or renewable energy. The specific applications change, but that underlying principle, that need to be innovative, it remains the same.
I think that's a really important takeaway for anyone who's feeling overwhelmed by all the noise out there in the market today.
There's a lot of it.
There is, but you don't need to be an expert in every single new technology or trend. What you need to understand are the core principles of business success, and that's what Fisher's book can help you do.
He's essentially giving you a framework for evaluating businesses.
A mental model.
Exactly. And that model, it can be applied to companies of all shapes and sizes in any industry.
Precisely.
So we've laid the groundwork here. We've seen how those ideas, long-term growth, thorough research, emotional discipline, they're just as relevant today as they were decades ago. But there's still so much to unpack in this book, so let's take a quick break, and we'll come back for part 2 of our deep dive into common stocks and uncommon profits. Sounds good to me. Welcome back to our deep dive into common stocks and uncommon profits.
We've been exploring the ideas of Philip Fisher, a real pioneer when it comes to long-term investing.
Yeah, and as we were prepping for this, something really struck me, just how much emphasis Fisher puts on self-awareness. You know, he doesn't just tell us to be disciplined.
Right.
He wants us to understand our own, temperament, our own tendencies.
It's not a one-size-fits-all formula.
Not at all.
He's giving us principles and wants us to figure out how to apply them in a way that works for each of us individually.
He's basically saying if you're impulsive or, if you get swayed by every little bit of market noise,
Right.
this buy and hold approach might be tough for you. It takes a certain level of, patience and conviction to stay the course when everyone else is freaking out.
It's like he's saying, know thyself, investor. I love that.
I love that too.
And this actually leads us into another tricky topic, selling. Fisher is not a fan of frequent trading, but he does say there are times when it makes sense to part ways with a company.
He does.
So he's not saying hold on to every stock forever.
Right.
When does he think it's the right move to sell?
He outlines 3 main scenarios.
Okay.
The first is, what if you realize you made a mistake in your initial analysis?
Happens.
It does. Maybe you overlooked something, a red flag,
Right.
or you were just a little too optimistic.
Everyone makes mistakes, even the pros.
Exactly. The key is to recognize those mistakes
And then what?
and cut your losses. Don't let pride or stubbornness keep you holding on to a losing position.
So, scenario number 2.
Scenario number 2 is when the company itself changes.
Okay.
The fundamentals deteriorate. Maybe they lose their competitive advantage, or the management makes a string of bad decisions. The story that you bought into, it's just not true anymore.
It's like you've been wearing rose-colored glasses and suddenly...
They come off.
Yeah, exactly. And you see the company for what it really is.
That's a good way to put it.
All right, so we've got mistake, we've got fundamentals changing. What's the third scenario where Fisher says it might be time to sell?
What if you find something even better?
Ah, okay.
Remember, his whole philosophy is about focusing on a select few truly outstanding companies.
Yeah.
If you come across a company that you think fits your criteria even better, it might be time to make a switch.
So it's not just buy and hold and forget about it.
No, you got to stay active. You got to be evaluating, making sure your portfolio still reflects your best assessment of where things are going.
And even when you are thinking about selling, Fisher wants us to be really clear on why.
Oh, yeah, absolutely. Are you selling because something fundamental about the company has changed? Or are you just reacting to the market going up and down?
Stay focused on the long game.
That's it.
Don't get distracted by the daily ups and downs. Keep your eyes on the long-term trends.
Now, I know this all probably sounds like a lot of work.
It does.
And to be honest, it is. Fisher himself admits that his approach isn't easy. It takes time, it takes effort, and it takes a willingness to keep learning, to keep adapting.
He's not promising us any shortcuts.
Not at all.
And
He's basically saying, if you want those uncommon profits, you're going to have to put in the uncommon effort.
it's about becoming a student of the market, right?
Yeah.
Always learning, always growing.
That's exactly right. It's not a get-rich-quick scheme. It's a roadmap. to becoming a skilled investor. And that takes dedication. And speaking of dedication and doing the work,
Yeah.
it brings up a question that's probably on a lot of people's minds. I mean, Fisher wrote this book back in the 1950s.
In a very different world.
Exactly. So all this stuff he's talking about, is it even relevant today?
That's a big one.
It is, and it's a fair question. The world has changed so much since then. The internet, globalization, technology is advancing at an incredible pace.
It is.
But here's the thing. The companies and industries that Fisher was writing about, those might not be the same today. But the principles, those are timeless. Understanding a company's competitive advantage, assessing the quality of its management, figuring out if it has potential for long-term growth, these are still the cornerstones of being a good investor.
That's reassuring, actually.
It is, right? It's kind of comforting.
It means that even though the world has changed, the fundamentals of what makes a business successful, those haven't really changed all that much.
Exactly.
Think about innovation. In Fisher's time, that might have meant investing in companies that were developing new ways to manufacture things or coming up with new products.
Right.
But today, it might mean investing in companies at the cutting edge of artificial intelligence or biotech or renewable energy. The specifics change, but the underlying principle of seeking out companies that are innovative, that are disruptors, that remains the same.
And that's a really important takeaway for anyone who's, feeling a little bit overwhelmed by all the noise and hype out there.
It's easy to get overwhelmed.
It is.
Oh, yeah.
But you don't need to be an expert in every new technology.
Yeah.
What you really need to understand are those core principles that drive long-term business success. And that's exactly what Fisher's book can help you do.
It gives you that framework for thinking about businesses.
Mental model.
Yeah.
That you can then apply to companies of all sizes in any industry.
So we've seen how these ideas, this focus on long-term growth, in-depth research, staying emotionally disciplined, it's all still relevant in today's market.
It is.
But there's one more big takeaway that I think we really need to explore.
Okay.
And it's something that, well, it might surprise you.
All right. You've got me intrigued. Tell me more.
Fisher was really upfront about how difficult his approach actually is.
He wasn't sugarcoating it?
Not at all. He argued that finding those truly uncommon companies, the ones that have the potential to deliver those extraordinary returns, it's incredibly challenging. And it takes a lot of effort, a lot of dedication to master his philosophy.
He's setting the bar high.
He is. It's almost like he's weeding out the casual investors.
Yeah, the get-rich-quick crowd.
Yeah, exactly. He's saying, look, if you're just looking to dabble, there are easier ways to do it. But if you're serious about building wealth through owning great businesses, then you've got to be ready to put in the work.
This is not a paint-by-numbers system.
It's not.
It's about developing a deep understanding of business. Honing your analytical skills.
Right.
Cultivating that patience to stick with your convictions.
He wants us to become students of the market.
Yes, always learning, always adapting. Fisher believed the real reward, it wasn't just the financial gain.
It was more than that.
It was the intellectual growth that came from mastering this craft.
That's a great perspective.
Right. It's not just about the money. It's about expanding your mind, challenging yourself to become a better investor.
And that's why his work has resonated with so many successful investors over the years.
I think so, too.
It's not about getting a list of hot stocks. It's about getting the tools you need to navigate the market and make good decisions.
Long-term decisions.
Yeah, exactly. So as we're wrapping up this part of our deep dive into common stocks and uncommon profits, I want to leave you with something to think about. Fisher believed that mastering his approach was hard work, but he also believed it was incredibly rewarding. Knowing that, does it make you more or less likely to try it?
That's the question we all have to answer for ourselves.
We do.
Some people might be intimidated by the challenge, but I think for those who are drawn to deep learning, for those who love the idea of uncovering hidden gems, those folks might be even more motivated to give it a shot.
Because the greater the challenge,
the greater the potential reward.
Well said. And that brings us to the end of part 2 of our deep dive into common stocks and uncommon profits by Philip Fisher. We hope you're enjoying this exploration of his ideas.
Me too. They're really thought-provoking.
Welcome back to our deep dive into common stocks and uncommon profits. We've spent this episode exploring the ideas of Philip Fisher, really digging into his approach to investing.
An approach that's all about finding those exceptional companies, the ones that have the potential to really deliver those uncommon profits.
Exactly. And as we were wrapping up the last part, we were talking about how upfront Fisher was about the difficulty of his approach, how it's not a walk in the park.
He wasn't afraid to tell it like it is. Finding those companies, the ones that can generate those incredible returns, it's tough. It takes real work.
He's definitely setting a high bar, almost like he's saying, if you're not serious about this, if you're not in it for the long haul, then maybe this isn't the path for you.
I think there's some truth to that. He's saying, look, you want to just play around in the market, there are easier ways to go about it. But if you're truly committed to building wealth by owning great businesses, then be prepared to roll up your sleeves.
So this isn't about following a formula.
Not at all.
It's about really understanding how businesses work, becoming a sharp analyst, and having the patience to stick to your guns even when things get bumpy.
It's about being a student, a student of the market, always learning, always adapting. Fisher believed that the real reward wasn't just the money. It was the journey of becoming a more skilled investor.
I really like that perspective. It's not just about the destination, it's about the growth you experience along the way.
And that's why so many successful investors have been influenced by his work. It's not about giving you a hot stock tip. It's about giving you a way of thinking, a framework for evaluating opportunities.
That you can use throughout your investing life.
Exactly.
So as we bring our deep dive into common stocks and uncommon profits to a close, I want to leave you with this. Fisher believed that mastering his approach was challenging, demanding even, but he also believed it was incredibly rewarding. So knowing that doesn't make you more or less likely to give it a try.
That's the question, isn't it? It's a personal decision. Some folks might be intimidated by the challenge.
It's not for everyone.
But others, those who are drawn to deep learning, those who love the thrill of the hunt, of uncovering those hidden gems, those folks might find it even more appealing.
It's like the harder it is, the more satisfying it is to achieve it.
Exactly.
The beauty of investing is that it's a lifelong journey. Always something new to learn, always new opportunities to discover, and always the potential for growth, both in your knowledge and in your portfolio.
Couldn't have said it better myself.
So keep exploring, keep learning, and who knows, maybe by diving into the world of Philip Fisher, you'll discover a passion, a knack even, for finding those uncommon profits. We hope you've enjoyed this deep dive into common stocks and uncommon profits and that you found Fisher's insights as valuable as we have. Until next time, happy investing.